Right, my name is Mike Brown and I work with a company called etfSA, Exchange Traded Fund in South Africa. As Mark said, etfSA is a business that enables you now to buy these indices. And you're buying the indices in the form of exchange traded funds or what we call exchange traded products. So let's explain, and I'm going to cover some ground that Mark's done already, but I don't want to cover too much ground. But let's explain again just what an exchange traded product is. It's a share, a security. It's listed in the stock market. And what it does, instead of giving access to just one company, now you all know shares, you can buy shares for ABSA Bank or First National Bank, or you can buy shares, and you probably don't want to do it in African Bank, but whatever have you can buy shares in any company listed in the stock market. That gives you exposure to the financial results and part ownership of that particular company. What an ETF does, it gives you access to a portfolio, so the whole group of companies. So an ETF is a security, but it gives you access to a portfolio or a fund. And that's why exchange traded products are often called exchange traded funds, and I'll run you through that as well. So what an exchange traded fund does, it trades in an exchange and it's a share, but it gives you access to a portfolio. That portfolio tracks an index. And that's what Mark's been talking about. He's been telling us what are indices. So an ETF is the easiest way of getting access to an index. And what an index is, it's a whole bunch of shares that follows a certain theme. So let's just go and revisit an index. This is the top 40 index on the JSE. And the top 40 companies are chosen in terms of their size and how much they trade. And it's alphabetical. So it starts at Anglo-American and goes down through Anglo-Gold, Ashanti, African Rainbow, etc., etc. And just in case you're saying that's not 40 companies, well, there's 40 companies because there's 2 pages. So it goes all the way down to Woolworths. So it starts at A and goes down to W. So when you buy an ETF, when you buy an ETF that gives you access to this basket, so you're buying a top 40 ETF, which would be, say, Satrix 40. When you buy Satrix 40, what you're actually doing is you're buying a portfolio where you own a little bit of each of those 40 shares. So I buy one share, one ETF, and that gives me partial ownership of a portfolio of 40 shares. Now that's a bargain. Huh? That's great. So it's like buying a box of chocolates. There's 40 different chocolates inside, and I own all those chocolates myself. I can eat them all myself. They're not anybody else's chocolates. So what I'm owning is I'm buying that index, and I'm buying it with a single security. And the amount of securities that I own is shown by this, what we call the market cap weighting. And you'll see some companies are bigger than others. Let's take South African breweries, SAB Miller. That's an important company because it makes beer, which I mean is something that's worthwhile. As opposed to, say, Woolworths, which just, sells food and women's underwear and stuff like that. So it's a bigger company than Woolworths. So when you're buying your ETF, 11% of your money, let's say you're investing 100 Rand, 11 Rand and 4 cents of your money is going to be invested in South African breweries, and 1 Rand 18 is going to be invested in Woolworths. But you own all those shares. So you own a portfolio of a lot of companies. What does that do? That diversifies your risk. You're not in one single company, which is risky. You're now in a portfolio of a number of companies, and these are the top companies in the stock market. Rembrandt, massive company. Sanlam, Sasol. I mean, Sasol is one of the biggest chemical companies in the world. You own a part of Sasol, and so on. So that's all an ETF does. It gives you access to those indices that Mark was talking to you about earlier. And I'll talk about the different types of indices that you get access to. So here's an ETF. Nice and simple. I don't know which share to buy. I don't know how to get research to say, should I be in this bank or this company or that company? I just buy an index. And that index is always going to be the best companies on the market because the JSE only selects the companies which are the top in terms of size and liquidity. So that's all my ETF is. Nice and simple, nice simple concept. So the case for an exchange traded product or an exchange traded fund is that you buy one ETF, one ETP, exchange traded product, but you own a whole portfolio of shares. Now, that's a bit of a bargain because you're only paying once to buy that security. So if you had to go and buy all 40 of those shares, you'd have to pay stock brokerage charges 40 times and JSE fees 40 times. And STT, which is tax, securities transfer taxes, is value-added tax on shares. You'd have to pay all those 40 times. When you buy an ETF, you only pay that once. And you don't pay STT because the ETFs already paid VAT on or STT on buying the portfolio, so you don't have to pay that twice. So it's a real bargain that, in fact, for a low cost, you're getting exposure to the stock market, the equity market. And that's what you want to do. I want to be exposed to the equity market. I want to own shares. And an ETF is a very good way to do it. And that's all it is. It's quite a simple concept. But as Mark explained, there's different types of indices, but that's effectively the case for an ETF. Now, I said that ETFs are quite cheap. That's just some numbers in terms of expenses. If you buy an exchange-traded fund on the JSE, the management cost of that fund is about 33 basis points and 0.3% per annum. You can buy unit trust index trackers, but they have double the costs. Or you can buy a general unit trust, and that has about 5 times the cost of an ETF. So they're very cheap. They're low cost because they're quite simple products. They just go and duplicate an index. They don't have to employ lots of people to go and select which companies to buy and do research and do risk management and do all the rest. Just buy the index. And you can buy them through low brokerage schemes, which is what etfSA is. It's a very low brokerage scheme. And as I said, you don't have to pay STT. So what ETFs are is a bargain. But what they are doing, and I'll show you some numbers later, is they're actually giving you access to a good portfolio of shares. So you're buying the best companies in the stock market, but you're buying it very cost effectively. How well do they perform? Well, this is in South Africa, and these figures are as of June this year, June 2014. And what this says is that all the equity unit trusts, and unit trusts I think are quite well known. A unit trust is an actively managed portfolio where the manager of a unit trust will go out and he'll select a portfolio of shares and he'll charge you quite high fees on the basis that he says that this portfolio can outperform the general market index. And all an index is the average performance of a market. Because the index measures, every 15 seconds on the JSE, the index measures what's the price of all 40 shares in the top 40 index, all 25 shares in the industrial 25 index. So an index gives you the average return of the market. Now, how many unit trusts in South Africa, and these are actual numbers, actually outperform the index over time? So you say, well, after a while, they should do quite well. I mean, 20 years, you expect most of them to outperform the index. But only 10% all actively managed unit trusts. And we're not mentioning any names here, but this is Coronation, Allen Gray, Sanlam Mutual, whatever the name they've got. 10% of them can actually beat an index. Okay? And if you say, well, okay, maybe over short periods of time they're a little bit better. But if you look at short periods of time, 6 months, 1 year, and so on, you find that 80% of all active managers in South Africa can't actually beat an ETF, the average return of an index. And so you say, well, is South Africa quite poor? I mean, can't we play rugby? I mean, we can play rugby. I mean, we beat the All Blacks. We can play soccer. We beat Congo. So there's nothing wrong with us. We're quite good. Are we bad managers? Well, the worldwide, that's a general phenomenon. But there's a so-called Sharpe ratio, and the Sharpe ratio, named after William Sharpe, who won a Nobel Prize, and he said, listen, the average returns of a market, 50% of the people in a market will outperform the market, and 50% will underperform. But if you start taking costs into account, because these guys charge you fees to do that, on average 70% of all the active managers in the market will underperform the index, the average return of the market. And in South Africa, it's 80%. It just says that South Africa has much higher fees than the rest of the world. And that's one of the phenomena in South Africa. We have very high fees. So what I'm also saying here is if you just buy the index, you're not buying bad performance. You're going to outperform 80% of the people out there. So I'm not saying that you aren't smart enough to pick the 1 or 2 unit trusts that will outperform the index, but you're smarter than I am. Because the guy who outperforms this 6 months is not the same guy who outperforms over the next 6 months, because there's a lot of volatility in performance. So buying ETFs is a nice, safe, low-cost way of investing in the market and getting returns on portfolios of shares. And those numbers, I mean, the industry hates those numbers, but those are well proven in the South African case. So the case for ETFs, you're buying an index, buying a very nicely diversified portfolio. The diversification reduces your risk, increases your exposure, so it increases your potential for performance. The costs are very low, and you're outperforming most of the guys out there. So if you want to make Allen Gray rich, and these guys can drive more Ferraris and have sort of smart clothes and all this, that's fine. Otherwise, just buy an ETF. Okay? And I don't have any smart clothes. Or you can see my old Tory in the garage downstairs. So ETFs are poor man's products, but they outperform 80% of everybody out there. And that's why they're becoming the most popular retail product in the world. 70% of all new money in America, retail money, which is investors like you and me, put money now into index trackers like ETFs, which exchange-traded products. Now, there's just 2 things I want to talk to you about, because every time I do a presentation, somebody asks me this question. Exchange-traded products is a generic term for a product that's listed on the stock market that gives you access to an index. And there's two types of exchange-traded products. There's ETFs, exchange-traded funds, which most of you know about. What an exchange-traded fund is that the rules of the JSE say that the manager who's tracking an index has to hold 100% physical underlying of that index. So if he's got 100 million rand invest in the top 40 index, he has to exactly replicate that top 40 index. He has to own 100 million rands worth of top 40 shares and exactly the weighting that the JSE allocates to that index. And there's all sorts of reasons why he has to do that, because there's a swap between the physical and the cash and all sorts of things like that, which I won't go into the technical details, but ETFs exactly replicate the index. So they're 100% physically backed. So they're completely collateralized. If you go and buy a top 40 ETF or even a DBX tracker overseas ETF, that guy will own 100% of the underlying index. So there's no risk for you. And he doesn't hold the shares. They're held in an insolvency remote trust, what we call a collective investment scheme. And the trustee is not appointed by the ETF manager. The trustee is appointed by the FSB, Financial Services Board, and approved by the JSE. So you have an external trustee who holds the portfolio on your behalf. So they're safe. They're not only regulated by the Financial Services Board as collective investment schemes, but they're also public companies listed in the JSE, and most of the floors above us are regulators in the JSE. So they're making sure that these things do what they're supposed to do, which is to be 100% collateralized and 100% holding of the underlying shares. So they're quite safe products. There's only two things that can go wrong with ETFs. The market can go up or down. What's it done the last 2 weeks? It's gone down. What did it do today? It went up. So you've got some risk in the price of the overall index going up or down. But as you're exactly replicating the index, if you listen on the radio in the evening and you listen to Bruce Whitfield or Stevie B or somebody, and he says the index went up 0.5% today, your ETF will have gone up 0.5%. He says the index went down 1% today, your ETF will drop in price by 1%. And there's all sorts of structures in the market to make sure that happens. So an ETF always trades at the value, the net asset value of the underlying portfolio of shares. So that's an ETF. There's something called an exchange-traded note. An exchange-traded note is also listed in the JSE as a security under the same main part of the JSE board. But with an exchange-traded note, the issuer of the exchange-traded note doesn't physically hold the underlying asset. And typically that's because it's difficult to do. You know, exchange-traded note might be in something like wheat or oil. So now what do? How do you go and buy all that oil? You go and stick it in the basement of the JSE and the stuff goes off after a while. So it's very difficult physically to hold the underlying asset. So JSE rules says that the issue of an exchange-traded note can cover his liability by using a futures or forward contract. And most of your commodities trade in futures and forward markets anyway. But if he's doing that and he's holding the underlying position on a futures contract, you then have to take into account the creditworthiness of whoever's issuing that note. So ETNs are a little bit more risky because they don't physically hold the underlying, but they hold the JSE requirements is that they exactly replicate whatever index they're tracking or whatever asset they're tracking, but they do it by the issuer guaranteeing that he's giving you the performance of the issuer. So then you've got to look how creditworthy is the company that's issuing this. And in South Africa, the JSE rule says you can only issue ETNs if you're a bank. So at the moment, the only ETNs in South Africa can be issued by investment-grade banks. If you're not a bank, you can maybe persuade the JSE that I can do ETNs, but they haven't allowed that yet. So the ETNs effectively issued by people like ABSA, Standard Bank, and there's one or two issued by, in fact, those are the only two major issues of ETNs in South Africa. There's one or two issued by Investec. So you've got two types of exchange-traded products, ETFs and ETNs. Most people buy ETFs. ETFs, very safe investments, 100% collateralized. Assets always held to support the products. Now, there are quite a few, as I think Mark was explaining, there's quite a few different indices. So when you're looking at ETFs, and it used to be easy when you started the business, and I started, I was the guy who helped launch Satrix 40, which is the first ETF, and that was only about 12 years ago. We only had one ETF. That was easy. Now we've got 70 of the damn things. Okay. It's not as bad as a unit trust because there's 1,000 unit trusts and there's only 450 shares in the JSE. So there's more unit trusts than there are shares, but that's another issue. But in terms of ETFs, we've now 70 of the things. So you've got to look at what type of ETFs you've got. And we've got various ETFs. If you want to invest in the South African share market, you can buy what we call a broad market index, top 40 index. And that would be something like Satrix 40 or RMB Top 40. And there you would look on the etfSA website where we have all the details on products, look at what the expenses of these different products are. We publish a table called total expense ratio showing exactly which ones have what expenses. The RMB Top 40 is a tip. It's half the cost of the Satrix Top 40, so it always outperforms the Satrix Top 40. And every month we put a monthly performance data sheet on the website as well, where you can check the day performance because the website gives you daily performance and all these things. And you'll see the RMB Top 40 will outperform the Satrix Top 40 because it's got lower costs. Exactly the same portfolio, still owns the same top 40 shares, but it has lower costs. So that's where you do your own homework. You may say, well, I don't want to be in the top 40 index because it's got a lot of mining companies in it. I want to be in a specialized index. I can now buy the industrial index or the financial index or the resources index or mid-cap index. And there's ETFs that will give you exposure to those indices. Satrix INDI, by the way, has been up until the end of September, the top performing unit trust ETF in South Africa for 5, 7, and 10 years. So long-term, nothing outperforms the Satrix INDI. And all it does is replicates the industrial index. Industrial index is worth looking at. Doesn't have any mining shares, doesn't have any financial shares, doesn't have any property shares. It's not a volatile portfolio. It just owns companies that make things and sell things. That's all it does. So it doesn't have unions and all those sort of issues. I used to work for a union, so I don't know, let's get that. Then we have different types of fundamental indices where you choose shares based on underlying accounting fundamentals, smart ETFs, balanced portfolios. You can buy foreign equities. You can go and buy the DBX checker. DBX is Deutsche Bank, right next door, the building next door, the JSE. Deutsche Bank's the third biggest ETF company in the world. And they issue ETFs on the South African stock market. You buy them in rands. But you buy the DBX checker, let's say the World Fund. The World Fund means you now own a portfolio of 1,600 shares in the 25 biggest stock markets in the world. So you buy one ETF and you now own 1,600 of the biggest companies in the world, a little bit of them. So you own a little bit of Google, a little bit of Microsoft, a little bit of Yahoo, a little bit of Sony, Toyota, whatever it is. You now own a nice portfolio of global shares. So I'm not putting all my money into South Africa. I'm putting my money into a global portfolio. What happens if the rand goes down, the rand appreciates, the price of that portfolio goes up in rands. So the pure rand hedge. So you would now look at putting some of your money into international equities, and there's a whole series of ETFs on the JSE that can give you access to the World Fund, USA, Europe, Britain, Japan, etc., etc. Government bond indices. You say, well, I want to have a very low risk portfolio, just buying South African government bonds. We hope they're low risk. We hope Eskom and Sanral and these guys don't go bust, but let's assume they don't. So you can buy a bond fund, which is not an equity fund. And there's new funds. There's ETfSA, the Govy, just invest in government bonds, or the LB, which invests in inflation-linked bonds, or RMB has an inflation-linked ETF. I want to buy listed property shares. Best performing asset class in the JSE after industrial shares over the last 10, 15 years. Property shares, this is not buying houses, this is owning shopping centres. These are the guys who own Sandton City, Hyde Park Shopping Centre, where people like Jenny Williams and others go and spend their Saturdays. So you're buying companies that own where you go shopping. So that's what a property share is. You can buy, you've got specialized ETFs that do property, and there's also ETFs that do commodities. In terms of ETNs, you can buy emerging market equities, you can buy a China fund. Deutsche Bank runs a China fund. That's the top 130 companies in China. That's been the best performing ETF over the last 6 months. Why? Well, China's starting to go up, despite what they're saying. What's the growth rate going to be in China and so on? There's more Chinese are going to become middle class in the next 10 years than the entire population of the United States, because it's just such a big population. Those middle class Chinese are going to buy motor cars, and they're going to go shopping, and they're going to go on holiday, and they're going to buy nail polish or whatever it is. They're going to do all the sort of things that are going to drive their stock market. So that's diversification, or you can buy an emerging market index. There's all sorts of products you can buy in commodities, wheat, copper, oil, etc. And you can even buy currency ETFs. Not all that attractive at the moment, because a currency ETF invests you in a deposit. So you can buy an overnight deposit in pounds or dollars. The problem is an overnight deposit in dollars pays you about 0.5% interest rate. So you're reliant purely on the exchange rate depreciating, the rand depreciating against the dollar. But you can buy currency ETFs or ETNs. And those could become quite attractive in due course. So there's a whole selection of ETFs. All the information you need on those ETFs is on the etfSA website. It gives you all the breakdown of all the different ETFs, profiles, intraday graphs, performance graphs, what's in each ETF, explains everything. If you don't understand all that, give me a ring and we can talk you through it. Now, how would you use ETFs? This is the bit that I want to finalize on. Let's say I'm now a long-term investor, and this is why ETFs and etfSA is really designed for people who want to put money away over a period of time. So let's say I'm going to put 1,000 Rand a month away, and we can do this on 300 Rand a month or 200 Rand a month or whatever number. Let's say we're going to put 1,000 Rand a month away in the Satrix INDI 25, and we're going to continue doing this for a long period of time. And these are actual numbers. This is up to end of June. After a year, 1,000 Rand a month is only worth 13,600. So I've spent 12,000 Rand, 1,000 Rand, 12 times, 12,000 Rands, only worth 13,640. But after a while, it starts growing. And after 10 years, 1,000 Rand a month, which you probably wouldn't miss, it means the girls have to just go to the hairdresser one less time a month, not buy a pair of shoes this month, whatever it is. The blokes just don't go and watch the soccer game every week, just go every second week. 1,000 Rand a month after 10 years, 422,000 Rand. If you keep that there for another 10 years, because you've now got 400,000 Rands worth of capital working for you, 4.5 million Rand. You want to retire rich, just put money away and keep it there. Any investment advisor will tell you, just get used to putting money away and just leaving it there. Don't access it. And the big advantage of ETFs is they're low cost. Nobody's going to come and take that away from you with the high cost structures. Nobody's going to misread the market. You're just buying the average return of the market. So if you want to retire at 4.5 million Rand, until the husband and kids they can get lost, you'll go and settle down in Belito or something with your 4.5 million Rand. That's what you do. But you've got to do it for 20 years. So get used to putting away money on a regular basis. If you can't afford 1,000 Rand, 300 Rand a month, or whatever you want to do, you might say, well, listen, I don't want to just put all my money into one basket. So let's give you a diversified portfolio, 300 Rand a month. We're going to put some money into the South African equity market. We're going to buy the Satrix INDI, top 25 industrial shares on South Africa, the best performing fund in South Africa. We're also going to put some money into the American market. DBX Tracker MSCI USA gives you access to the top 600 companies in America. So I'm just going to buy the whole top 600 companies in America and a little bit of each of those. That's the DBX Tracker. I'm going to buy a property ETF, PropTrack SAPY, it's a property index. And I'm also going to be cautious in case things go wrong. When the market went down 7% the last 2 weeks, inflation-linked bonds has carried on going up because inflation-linked bonds just go up with inflation rate. Inflation rate goes up 1% this month. The value of inflation-linked bonds goes up by 1%. So they're linked to inflation. So here I've got bonds, property, offshore equities, local equities, 300 Rand a month. After 3 years, 59,000 Rand. After 5 years, 123,000 Rand, and so on. So I can also run a portfolio of different types of asset classes. And as you get to understand the markets better and you come to more seminars, and we'll talk to you through all these, how you can manage your portfolios, that's all a unit trust does for you. And I'm not trying to be nasty about unit trust, but when you come to our portfolios, we'll show you that no unit trust giving you that performance over 5 years because the cost structures are just too high. So you can start running your own portfolios. Let's now start being serious and put 1,000 Rand a month away into those 4 different ETFs. And after 5 years, that's worth 400,000 Rand. And after 10 years, that'll be worth about, times, it'll go up by another sort of triple. And over 20 years, that's 1,000 Rand a month, 4,000 Rand a month will be worth in the region of about 10 million Rand. So all you've got to do is get used to the idea. And a lot of you are young. A lot of people tell you investing and saving is difficult. It isn't. If you can get used to the idea of putting 10% of your salary away when you're young, I'm not too sure about this bloke in front. He's not as old as I am, but I mean, but the rest of you are all babies, particularly the ladies. The ladies are all very young. Put the money away and just leave it there and let it grow for you. And ETFs are a fantastic mechanism for doing that because of the low risk, low costs. So let's say you now want to run your own portfolio, and I now want to spread my portfolio amongst different asset classes. So I want to be some money in South African equities, let's say 40%, 30% of my portfolio should be in foreign equities, and 30% I want to make sure that nothing goes wrong. These things just sit in income-bearing assets, not equities. So it adds up to 100%. And I now want to run a portfolio, and here's just an idea on a portfolio. So we'll put 30%, 40% into South African shares, INDI, financial index, the ERAFI overall, which is the top 40 index, fundamental index, USA, world, so 30% offshore, and 15% inflation-linked bonds and 15% in property shares. Over the last 3 years, this is up to middle of September, that portfolio went up 24% per annum. Now, I'm not giving you rand numbers, I'm just giving you percentage numbers, and 21%, 22% over 5 years. Just to give you some indication, the unit trust industry, low equity funds, high equity funds and flexible funds, this is the average return in the unit trust industry. That's significantly higher. Significantly higher. So when I say that the unit trust industry in South Africa is very expensive, it is. And so I'm not saying don't give your money to a unit trust manager. You can go and buy a balanced portfolio from whoever, but also just go and put some money into ETFs. And if you're not comfortable running your own portfolio, we have seminars where we teach you how to run your own portfolio. Just come to etfSA and ask us to give you some advice on running our portfolio. And we can then do that to you. And that sort of performance, 24% per annum, means your money triples over 5 years and doubles over 3 years. So that's quite a nice return that you're getting. Just using nice, simple, exchange-traded funds, buying indices, what Mark said is the basis of investing. So starting off with the ground floor, but doing rather well. Now, ETfSA, I'm going to promote our business a little bit, but we run a platform for ETFs, and so do one or two others. You can buy the Satrix investment plan and so on. You don't have to be rich. You can start investments with us from 1,000 rand, lump sum. You can obviously invest more than that. If you want to bring us a couple of million, that's great. That's nice. And a lot of clients do. Or we do debit orders from 300 rand a month. So you just give us your bank account details. We'll process the debit orders for you. We automatically reinvest your dividends. So all the ETFs pay dividends 4 times a year. So any money they collect from the companies in the index, they'll pay those out to you at the end of every quarter, like a unit trust. We'll automatically reinvest it. So you're capitalizing your dividends. But if you want the dividends paid out to you, we'll do that. But the best thing to do is capitalize the dividends. We charge you a fee over the full year. So we don't charge you for every single transaction. So if you invest 1,000 rand, we'll charge you, the maximum fee is 0.7%. The fee goes down as the investment goes up. 0.7% means you're spending 7 rand a year. Total fee. That covers client administration, management, sending you tax certificates, reinvesting your dividends, collecting your debit orders, sending you statements. Everything's included in that fee. Now, if you go to a stockbroker, they've got a minimum fee per trade of 50 to 100 rand. And we're charging you 7 rand over a year. So going to a list platform, same thing when you do with ETFs, with unit trusts, is obviously a big advantage. Third-party investments, very popular with people increasingly. Now, I spoke to 2 people today. I did presentations to quite big clients. Both said to me, listen, I've got 4 grandchildren, 5 grandchildren. How do I have a third-party investment? You can do that. You invest in the name of the child as the investor, but you're responsible for that investment. And we specialize in running those types of portfolios. And so when the child then turns 18 or older, you then transfer control of that portfolio across to them. But until then, you're in control of that portfolio. That's the best thing you can do. Rather than giving them something that they're going to wreck, some toy, just put money away for them on a regular basis. ETFs are ideal for investor clubs and stockfels, as you've heard from the various presentations we do in the JSE, and we specialize in ETFs only. So ETfSA is quite a good product platform to do ETFs on. Just to show you the difference in fees, if you were going to invest in 5 different ETFs, 1,000 rand per ETF, 5,000 rand a month, in a stockbroker, this is the cheapest stockbroker. This is, we won't mention it, but it charges you 372 rand a month, 4,500 rand a year. ETfSA charges you 43 rand a month or 315 rand a year, compared with 4,500 rand. That's the benefit of using an investment plan platform. Now, if you're a guy who just says, well, I own 10 shares and I'm going to own 2 or 3 ETFs, so I'm not worried about reinvesting the dividends, etc., go to a stockbroker. But if you're a normal guy, he wants to put debit orders in, stop the debit orders, increase the debit orders from time to time, change the portfolio, that's what we designed to do at low costs. And that's it. There's some contact details there. I see you've all got packs there, so have a look at the stuff in there, but go onto our website, give me a ring, or chat to Jenny or Cheryl outside or other people, and there's some details there, and I think Waldemar wants us to get into questions.